Finally made it to Friday. In just 30 minutes until the start of trading, I'm Matt Miller.
I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, China opens an antitrust investigation into Qualcomm as President Trump and President Xi jockey for leverage before they meet at the end of the month.
And on the earnings front, jeans maker Levi's raises its full-year outlook, but warns that tariffs are starting to bite.
Plus, Wall Street banks gear up for earnings season that kicks off next week. Investors are going to be watching deal-making performance after $1 trillion in deals were done during the quarter.
A lot of enthusiasm there, but where there's not enthusiasm is some corners of tech this morning, Matt, especially with Qualcomm. It's one of the ones we're watching, down 1.4% in the pre-market. As you mentioned, China investigating the company for suspected violation of the anti-monopoly law over a deal to buy Outtalks, a auto tech company. That deal was announced way back in June, and it's yet again tension between the U.S., China, American companies ahead of talks between Xi and Trump.
All right, that's a story we'll cover. Also, Levi Strauss warns that it is starting to feel the pain of tariffs. It continues to expect tariffs of 30% in China. You can see that the shares right now down 8.6%, and we're going to talk about that. I mean, really a legendary, iconic maker of jeans, although the product has changed quite a lot, Dani.
I'd assume so. They don't have the looms. They're made by machines. I should say shares are up 45% year to date, so a little bit of weakness today isn't ruining the overall rally. Let's begin, though, with China targeting Qualcomm. Bloomberg Intelligence Global Head of Tech Research Mandeep Singh joins us now around the desk. Mandeep, it does continue to feel like these companies are being thrust in the middle between disputes with the U.S. and China. Is that what's happening here or something different?
I mean, look, when we look at NVIDIA, they acquired this company, Mellanox, a few years back, and there was an investigation opened for that as well. Right now, we are in an environment where any company on the hardware side or chip side with exposure to China revenue, they are in the crosshairs of this negotiation and, you know, the trade dialogue that's going on between U.S. and China, and it's not surprising that, you know, Qualcomm having got almost 60% revenue exposure, so clearly, you know, it's not that unexpected that they are caught up in this.
And Intel, what's the chip they have, Panther Lake or something? It's apparently super special for laptops. Intel's market cap may overtake Qualcomm today, which I find pretty amazing because, you know, last year we were talking about the possibility of Qualcomm buying Intel.
Well, look, the U.S. government, when they took the stake in Intel, it was pretty obvious that, you know, Intel is front and center in terms of both their fab side and as a company, you know, the government wants them to do well. And with all these deals getting announced by OpenAI with NVIDIA and AMD, it makes you wonder, what would it take for one of these companies to announce a deal with Intel? NVIDIA did that with Intel, but it wasn't for the foundry.
Right,
so
that's the
need
question.
That foundry component. And
so do you expect that, Mandeep?
Do
you think that Intel is going to be making chips for companies like NVIDIA?
I don't know if it will be NVIDIA, but I do expect some sort of a deal for Intel fab, simply because the government has made it very clear they want more onshore manufacturing, and Intel is the only company or the biggest company that has the fabs. You have Global Foundries and other companies as well, but Intel is front and center from that standpoint, advanced node capacity here in the US. And I expect with all the money that's going on at the data center level, you know, we're talking 50 billion per gigawatt. Well, there is 75% of the components in that data center is chips. So where are those chips made? By TSMC outside the US. And so that's where the question will arise, why can't it be Intel in some capacity? And I would say companies that are at the front of it, you know, OpenAI and Google and Microsoft, maybe one of those. So who knows?
All right, Mandeep Singh, great to have you here today. Mandeep covers tech for us from Bloomberg Intelligence, one part of a team that makes up the deepest and most robust tech coverage in the industry. The other part is Anurag Rana, and we're glad to have him on today's show as well. As shares of digital infrastructure company Applied Digital surged this morning, the company smashed earnings estimates with announcement that it's in advanced talks to fill its second data center campus in North Dakota. Anurag, what do we know about the data center story? How is this shaping up?
So we already heard yesterday there is a shortage of capacity for Microsoft. Bloomberg News did a very good story on it. And this is really the theme at this point. It's not as if you can spin up these data centers overnight. It takes time. So what happens is the entire supply chain, Mandeep just talked about, $50 billion for a gigawatt. Where is all that money going to? They're going into chips. They're going to creating data centers. So for a company like Applied Digital that provides, the cooling, the infrastructure and area, or you can say physical area for people to put their servers in, this is going to be a boom for them. It's already happening. You can look at Digital Realty, Equinix, and then you can look at the companies like CoreWeave or Nebius. So all of them are seeing the downstream effect of all this funding coming in. And it's no surprise that we are, in a situation like this right now.
Anurag, the part of the reason we also saw Applied Digital rally, though, was because it talked about that CoreWeave had signed a lease for them. It kind of surprised me that they had been building these data centers without first securing a tenant. Matt and I also spoke to the CEO of Fermi yesterday, which is building energy resources, but again, without customers. Building first, customers later. Sure, there is a crunch now, Anurag, but is there a risk in that the build-out just goes too far and these companies don't get tenants down the road?
That is a very big risk, but I do not know whether we are 2 years away from it or 3 years. But look at it from another point of view. Look at any digital transaction right now. It has to have some element of AI in it. So when you look at a particular data center, and you can ask any company at this point, if they have X amount of workloads or 100 workloads right now, how many of them have any element of AI in it? I think that number is very low. It doesn't matter whether I'm opening my email or chat. There is more and more AI-related features out there. It could be on any other factor that you can think of. So those workloads have to transfer from a CPU-oriented workload to a GPU-oriented workload. And given the shortage of, you could say, capacity that we're hearing from Microsoft right now, I think we have a few years to go before we can say that, we are going to be in that big crunch.
All right, Anurag, thank you so much for joining us this morning. Anurag Rana of Bloomberg Intelligence off the back of Applied Digital, up nearly 30%. Now, in other earnings news, Levi's raised its full-year outlook. Shares are down, though, 9.6% in the pre-market. They warn that tariffs are starting to have an impact. Joining us with more is Bloomberg's managing editor for global business, Shelley Banjo. Shelley, it's remarkable to have a company that raises its outlook, that profitability looks good, that consumers are having and absorbing higher prices, and yet shares are down almost by 10%.
Yeah, people are wondering what is sort of, why isn't it better? And so, when your stock is up as much as Levi's is so far this year, they're talking glowingly on the call about how the consumers are really getting into their jeans and their offerings, and yet they only raise their outlook by a little bit. And so people are asking what gives. And I think the issue is also around profit margins. They're raising their sales. They're saying sales are going to be good, sales are going to be good. Profit, maybe not so much. Temper the expectations because of the tariff impact.
It's amazing. I mean, what a cool company to cover, right? It's got to be one of the most well-known clothing brands in the world. But the consumer has to be there, right? To your point about data centers, it's got to be the same for jeans as well. And we're at a point where maybe there's a little bit of concern about the consumer, especially considering what we heard from, for example, Chris Waller today on the labor market.
Yeah, I mean, people are still buying, especially showing up for something new. So what they have done right with Levi's is launch all sorts of new partnerships with people, Beyonce, Shabuzi, like these folks that, really enter into the...
What's Shabuzi?
Matt, you have some homework to do. I'll send you a Spotify playlist later. But they're entering into the marketplace where people are talking about. But that doesn't mean that they are still not going to suffer from these big tariffs that are hitting them pretty hard.
Is that like a labubu?
No, wait. To be clear, it's a person, not a thing.
Okay.
You're like,
Yeah.
what's a shabuzi? It's who
Okay. I
is
got it.
shabuzi.
Okay.
Yes, correct.
Shelley, thank you very much. Shelley Banjo runs company coverage for us here at Bloomberg. Quick check on what's going on in futures. Pretty little change really across the indexes, and we actually fell about 0.3% yesterday on the S&P 500 in the cash session. It does look like, you know, green arrows at least across the board here, 0.1% the gain, but not too impressive.
Yeah, Chris Waller at least helping with small caps in the bond market rally, saying that we might have a negative payrolls report had we had the data. Elsewhere, coming up, Stellantis shares, they are moving higher, more on the automaker, and some solid sales coming from them as they move higher by 1% in the pre-market. You're watching Bloomberg Open Interest.
Let's get to high interest now. Look what's making headlines around the world. Treasury Secretary Scott Bessent has reportedly narrowed the list of candidates for Federal Reserve Chair to 5 from 11, including Fed officials Mickey Bowman and Chris Waller, director of the National Economic Council of Advisors, the National Economic Council, Kevin Hassett, and ex-Fed Governor Kevin Warsh, but notably BlackRock's Rick Rieder. Bessent plans more interviews before sending a short list to President Trump, who's expected to name a new Fed leader early next year as questions remain over the administration's commitment to central bank independence. And Venezuelan opposition leader Maria Corina Machado won the Nobel Peace Prize, praised as a woman who keeps the flame of democracy burning. The decision sidelines President Trump, who's long sought the honor and whose aides called the move political. Trump's reaction could shape his next steps abroad, including peace efforts in the Middle East and pressure on Venezuela. Stellantis shipments jumped 13% last quarter, led by a 35% surge in North America as the car maker restocked U.S. dealers with models like the Ram 1500 pickup truck. The Rebound signals early traction for new CEO Antonio Filosa's turnaround push, even as unions in Europe sound alarms over production cuts. Stellantis reports full results October 30th. And we are very much looking forward to that. For a bit of a preview, although it's kind of early, Bloomberg Intelligence Global Autos and Industrials Research Analyst Steve Mann joins us now. And, you know, I'm a Mopar or no car guy, so I'm excited about this, Steve. But do they have the product? Do they actually have the Chryslers, the Dodges, and the Ram trucks to do as well as we expect on earnings?
I think a lot of consumers are thinking the way you're thinking about Stellantis and its brands in North America. They do have very, very strong brand, very reputable brand, and I think that's been the issue with Stellantis in North America is that they've over the past few years, after the merger when they started cost cutting, they've discontinued a lot of the popular brands. So actually this 13% growth globally, 30-some% growth in North America, maybe just the start. It's off of a small base, but they are bringing some of these cooler brands that resonate with consumers back, like the Hemi V8 for the Ram trucks and the Jeep Cherokee.
Should be noted, Matt did a fist bump when you talked about
Because I have a Hemi. Because I have a 6.4-liter Hemi in my Challenger.
Okay, so it reintroduces this model that, Steve, that people like Matt like, but it's also at a moment, Matt was also talking about this, that the consumer is maybe challenged. These are big trucks that cost a good bundle of money. So what is the dichotomy there between getting that audience, having them pay for it at a time when they're weak, despite some of these iconic brands coming back?
Yeah, you're absolutely right. I think you've seen some of the leasing programs that are coming out. They've been extending it to 72 months, 84 months to make them make vehicle purchases affordable for consumers. But what's been happening over the last few years without the Hemi, without the Cherokee, is that Stellantis has been losing market share to GM and Ford. And I think in this environment, there are a lot of consumers that want those vehicles back. The orders have been strong for those new vehicles from Stellantis. So we're actually looking into possibly a fierce fight for market share between the Detroit Big Three.
How does Filosa set up this company for the future, Steve, I wonder? Because you know, the Dodge Charger EV, which is kind of a silly product to offer a muscle car audience that really wants an internal combustion engine. It's a fantastic product, but doesn't sell, right? It's overpriced. Yes. The same problem with a lot of the Jeeps. Their prices are sometimes over $100,000 for a Grand Wagoneer. How are they going to compete when consumers do want to buy EVs, and in a world when people are tired of paying six figures for a pickup truck?
Yeah, I think they do really need to listen to the consumers. I think cars, some of the pickup trucks, some of the cars like the Charger, really shouldn't be offered as an EV because people buy them for the noise, for the sound, for that engine sound, right? For the exhaust sound. So Porsche, as you know, has actually dialed back their EV endeavors. So, but Stellantis is actually transitioning. Look, when they were merged into Stellantis, there was a big push to achieve cost savings, and that's what Carlos, the previous CEO, did. And I think now with the market shifting, there is more focus on let's not just rebalance that focus, not just internally, but externally. What are the customers saying? What are the dealers saying? And I think they're setting themselves up to better sales comps in the coming quarters, like we just saw in the last quarter.
What is at the moment separating the Steves and the haves and have-nots? You have Stellantis and Volkswagen also reported stronger sales, but at the same time, BMW and Porsche lowering their outlooks in recent weeks. What's distinguishing between those that are succeeding and not in this environment?
Yeah, I think where Stellantis is at, they're at a low base, right? I think a lot of the profit that Stellantis generates actually coming from North America. Now, there is a risk. Let's not forget the risk. The European market has yet to recover. We heard from BMW just recently dialed back some of their forecasts. So, but I think Stellantis is already at low base. We know that the European market is weak, but where the biggest opportunity for Stellantis to actually improve the bottom line is in North America, and they're doing quite a bit of things in terms of meeting customer expectations over here in this part of the world.
All right, Steve, thank you very much for that. That's Steve Mann of Bloomberg Intelligence. Now, a quick check on futures, roughly about 10 minutes before the opening bell. We are higher, barely so, after a weekday that didn't maintain momentum yesterday. Maybe we can thank Chris Waller for the gains today, who was out saying that he is focused on the payroll, on the labor market, and there could be negative payrolls. Of course, Matt, we don't actually know if it was negative payrolls because we don't have the data. We might not have data next week. We might not have CPI unless the BLS is successful in getting people back. But even so, those concerns with us flying by, Waller sending bond yields lower and small caps rallying.
Right. I think also the idea that Waller is still on the list, that Bowman is still on the list, even though they didn't dissent with Stephen Myron for a bigger cut at the last meeting, to some extent reassures investors that Fed independence remains a distinct possibility.
Yeah, I also wonder if people are looking at Waller speaking, and it's almost like a Fed chair, shadow chair effect, where they're looking at him saying, okay, when Waller speaks, maybe I'm looking at the next person leading the FOMC speaking, and therefore I trade it.
Definitely something that people are talking about in the markets today. I've been reading Neil Dutta on this very interesting stuff from Renaissance Macro. Coming up, green shoots in other parts of the market outside of AI. Abby Yoder of JPMorgan Private Bank joins us to tell us what they are and how to capitalize. This is Bloomberg Open Interest.
Bank of America says that investors are flocking into everything from stocks to bonds and cryptocurrencies, signaling that risk demand remains strong despite the shutdown. Equity funds drew $20 billion for the week. U.S. stocks posted a fourth week of inflows. Joining us now, Abby Yonder, U.S. equity strategist at JPMorgan Private Bank. And Abby, we were just talking about one of the sectors that's been participating in this rally that wasn't to start the year, which is healthcare.
Yeah.
Now, that might be policy-based, but there are potentially some risks here that you're seeing too with that rally.
Yeah, I mean, so we had downgraded healthcare to neutral after the election last year, and it was really about policy. Like, we were just worried about what would happen, and that doesn't necessarily read through to fundamentals. It's more on the valuation side, which we saw throughout this year, right? It was one of the worst performing sectors. The valuation was really attractive relative to its own history, relative to the market, and so there was a lot of interest in it, right? Because in a market where everything's kind of expensive, clients are looking for areas that might be more attractive. And you got a little bit of a policy lift, a week and a half ago, and so you've seen valuations re-rate. Now the question becomes, okay, what happens from a fundamental perspective? We've got a lot of patent expiries coming up for these large cap pharma companies. Are they able to backfill those pipelines? Is now like the real question as it relates to fundamentals over the longer term.
That's too far into the future for this market, isn't it?
It seems like it. It seems like everyone's really focused on December, right? Let's get to the end of the year where it feels like momentum just is really there, right? Everyone was talking about September is really seasonally hard, great September. So when does that really break down? I mean, I think almost this government shutdown without the data being, released all the time, it feels like markets kind of just have no reason except for to move up.
So it's not necessarily bad for markets right now. It's pretty good.
Yeah, but I think, absent the macro data, right, we do have earnings that are starting next week. And I think that's going to be a real focal point, notwithstanding the fact that we aren't getting data elsewhere. Just around primarily, what's going on with AI. We've seen eye-popping numbers. I think that's the struggle, right? I think it's labeled a bubble because of the numbers, because it's just really hard to wrap our heads around. But there's real ROI on these investments for a lot of these hyperscaler companies at this point. As long as the direction of travel is up for those ROIs, I think that's very important for the market.
Yeah, it seems like every single day we're discovering some new data center company that we didn't know about that's up 0.25%. I think it's, Applied Digital is up a bunch today. So a lot more to discuss on that front as it lists everything up. Abby, you are staying with us. That's, of course, Abby Yoder. And a quick check on where futures stand ahead of the opening bell, Matt. We are still higher, to be fair. Only 0.08% for the S&P 500 after falling yesterday, but it is the Russell 2000 that's doing better after bond yields also coming back below 4.1%.
Yeah, interesting moves. Interesting that we're holding at these very high levels, and every day we learn about a new data center company that's going to produce more electricity than the entire Eastern Seaboard needs. We're back with the opening bell. This is Open Interest. We are moments away from the start of trading on this Friday. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at pretty little change on the indexes, on the futures here. 0.1% for the NASDAQ and the S&P. Russell 2000 futures doing a little bit better, as Dani points out, likely because Chris Waller came out and said he wants to continue to cut rates, and that's what they need. University of Phoenix ringing the opening bell after an IPO at the New York Stock Exchange. They've been trading for a couple of days and are doing quite well. You made a couple of bucks if you bought that stock, if you got the syndicate. And Jefferson Capital also been trading now for a couple of months, and they've also done fairly well. If you got it at the syndicate, you're doing even better than if you bought it on the first day of trading. They're up about 25% so far. Dani, what are the stocks that you're watching today? I'm pretty excited about one.
Yeah, okay. I hope it's Qualcomm because that's what I have for you.
Yeah,
okay, perfect. We've made TV magic. Qualcomm down 1%. Matt, that's off the back of China investigating them. There's suspected violation, they say, of an anti-monopoly law over a deal to buy Outtalks. It's an auto tech company. It helps cars talk to each other for safety and the like. It is the latest in a string of tit-for-tat moves, with President Xi Jinping and President Trump jockeying for leverage before a key meeting in South Korea that's due to take place at the end of this month, Matt.
Yeah, I'm watching, and I think we'll have a chart of Qualcomm versus Intel, because Intel has done really well, obviously, and Qualcomm less so. And as a result, Intel is, at the open, it was worth $175 billion. Qualcomm was worth $178 billion. And those two may flip-flop in terms of market cap. So we're looking to see what happens today. On the earnings front, Levi Strauss raised its full-year outlook, but the shares have been decimated after a warning that tariffs are starting to have an impact. Of course, Levi has been an outperformer this year. I think it was up 45% year to date, but it's losing a tenth of its market cap in today's trade. A pretty harsh punishment for something that you must have known was coming.
Well, also they actually did well. Their profitability was better. Their sales have been good, but it's run up a lot this year.
Yeah, because of Shabuzi.
Yes,
Apparently.
and I think Beyonce, did Beyonce do a Levi's thing? I'm not sure. But
yes, but not Sydney Sweeney.
Notably not Sydney Sweeney, correct.
Still with us here on the desk is Abby Yoder, U.S. equity strategist, JPMorgan Private Bank. And, you know, we were talking, Abby, about some of the other sectors that you're watching closely. AI takes almost all the air out of the room. But banks start reporting next week, and it's got to be fascinating because they've done so much in M&A. We've had so many IPOs. We've had so much trading revenue, as evidenced by Jefferies. So what do you expect?
We've had so much of that in one quarter, right? Like there have been years of this being like depressed activity, right? And I think that's where it's really important. Like those are big numbers. You all have, Bloomberg has done a great job in terms of talking about, okay, $1 trillion worth of deals in the quarter, but that's after, 2.5 years of kind of nothing. So that's something that we're focused on. The banks start reporting next week. And the unique thing about them also is that they touch every part of the economy, right? So they can really get an idea of not only what's happening from a capital markets perspective, but what's happening with the consumer, right? There's been a little bit of concern given some notable bankruptcies over the past couple of weeks, like what's going on with the lower end consumer. We can get that read through banks. And so that's something that we're going to be focused on. And then also, what's their outlook for the economy? What are they thinking in terms of their net interest income outlook as you've got, the Fed lowering rates on the short end, but the longer end remaining relatively anchored, which is the net positive in terms of their net interest margin expansion.
Can I just say on that front, it's incredibly confusing because there's some areas that look really weak. You pointed out the lower end consumer, housing looks really weak. And then on the other hand, corporate profits are really strong. The stock market trading at all-time highs, retail sales have been really robust. You put all that together, do you have a clear picture of where exactly we stand?
Well, I think the market and the economy are not the same thing. They never really have been. And when you think about the S&P 500, yes, it's definitely tied to consumer spending, but it's not 70% of what is economic growth. And right now, we're also in this very unique period where it's been essentially AI driven, right? We all know that there is a concentration, concept within the S&P 500 over the last 2 years, both from a market cap perspective, from an earnings contribution standpoint, but importantly, what we saw starting in 2Q and what we expect, in 3Q is that 493, so the rest of the market, starting to participate from a positive growth perspective, right? Like flat to negative growth on a quarterly basis for, 2+ years, given the high interest rate environment. That's changing at the margin, so you can see more cyclical parts of the market start to, do better in that scenario.
If we are in a bubble and it bursts, obviously that kills the entire index. How do you hedge against that? And are you concerned about an AI bubble?
We're not concerned about an AI bubble at the moment. I think the rhetoric, again, I think this goes back to the numbers that we were talking about. There's big numbers. It's hard to understand. It's a very complicated technology that seems to be taking off.
By the way, yesterday, Bruce Richards of Marathon told us he thinks there's a bubble in people talking about the possibility of an AI bubble.
The two can exist at the same time. Just pointing that out.
But wouldn't you think that a bubble would be consensus, everyone agrees it's a bubble, and then but because there seems to be.
Having lived through 1999 and 2000, I know that's not the case.
Well, I think to get to that point, there are going to be pockets of unproductive spend, right? That's the definition of a bubble. That's certainly going to happen with the amount of capital that we've seen thrown at this, and you've heard CEOs of these, hyperscaler companies say that in so much as, that they think, the risk of being behind is just so much bigger.
Exactly what Zuckerberg said. That's right. He said, we could misspend a couple of $100 billion, and that would be bad. But the bigger risk is that we don't spend enough.
And that's why you have everybody piling behind it. We were just talking about this earlier, this idea you have people building data centers, energy resources without people to even back it. And at the same time, these companies get business models that are increasingly complicated as they all invest and have revenue in each other. How hard is it to invest in this place in the market, which is increasingly making up the entire market, and be a generalist and not fully understand all of that? Does everyone need to be an AI expert in order to invest in this equity market right now?
I mean, to a certain extent, and you need to know how it works, right? And I think that's something you have to use it, you have to understand it, you have to understand how your business is going to use it, and really think about different use cases across that. But I think what's interesting, the biggest bottleneck right now is energy, right? That's the problem with this. It's building that out, but this grid problem that we've had in this country, right, like an aging grid that was, exposed to power outages, that was happening before AI, right? So if we get this investment in the grid where we get this upgrade, that's not lost because if AI ends up being a bubble down the road, right? Like we needed that anyway. This is getting kind of momentum behind it from like a regulatory standpoint that I think is important and good and won't be a bubble down the line in terms of that build out.
So your base case, we're there. For the mid-2026, your base case is 66.50 to 67.50.
Yes.
Does that mean you lean towards the bull case? Because since we've already achieved that, we'd have to stagnate to stay at your base until June of next year.
Well, and look, we've been operating in an environment that's like very low volatility. That's not something that we expect going forward, right? Like this is going to be a choppy, particularly as we go into the end of the year, where we have this kind of really tenuous relationship where the labor market seems to be weakening and inflation seems to be moving higher. Like I think that's going to create some volatility within the market. Ultimately, we think we avoid a recession. But to your question, we've been increasingly talking about our bull case. We'll get a lot of information through 3Q earnings, but what gets us to that 72.50 of our bull case is, a combination of better earnings growth. We're below the street in terms of 2026 earnings growth, so maybe coming up to where the street is, and then also a higher valuation, which I think is one of the things that's like a little bit eye-popping in terms of thinking about staying at a 22 multiple in the current environment.
There are lots of parts of this market that are rallying, though. I saw this statistic from Bespoke that really surprised me, that micro caps over the past 6 months have rallied 20 percentage points more than the S&P 500, and the last time that happened was out of the 2020 nadir into 2021. If you look at that, is it a reacceleration of the economy trade or is it a speculation trade?
I think it's probably a little bit of both. I think it's, if you break that down, I'm sure what's driving that is probably microcap tech names or those tied to quantum computing or something like that. But there's an element of, when you look at when those started to rally, it was August, right? So preemptively in front of what the Fed was going to be doing. And just because you're not seeing the 10-year move materially down doesn't mean that you're not seeing financial conditions ease, right? Which is the key component when you're thinking about, what could get growth to reaccelerate and what has been holding back, other parts of the market on the small cap side who are, much more floating rate debt exposed, which, has much bigger ramifications from an interest rate perspective. So the fact that we have financial conditions coming down because we have high yield spreads where they are and we have the equity market where it is, that is a positive feed through into growth. And that I think is a net positive for those smaller cap companies as well.
Abby, we're going to have to leave it there. Thank you so much. It's been
Thank you.
fantastic. Enjoy the rest of your Friday. That is Abby Yoder of JPMorgan Private Bank. Let's get a check on a stock market that's going a whole lot of nowhere right now. We are up 1/3%. That's better than we were in the futures trade when it was literally flat. It's a pretty even split between what is moving it and what is not moving it. It's tech on both sides of the column. Apple, Alphabet, JPMorgan, so the big cap tech stocks are the things that are helping us, along with banks. Matt mentioned we're going to get the banks kicking off reporting season starting next Tuesday. On the other side, it is Amazon, Meta, AMD also falls by 1% this morning. United Health also down nearly 1%. If you look at the sectors, how they perform this week, you get a very AI flavor to things. Because if you look at utilities, yes, that's at the top of the pile. That's not a safety trade, though. It's so many energy stocks and power providers. Abby Yoder was just talking about this. The desire and the picture that still needs to be figured out for this AI boom is how we power the things. Infotech, that follows close behind. Again, maybe the same story. On the bottom of the pile, you have real estate, energy, materials, industrials, so kind of a more cyclical type flavor to the things that have been falling. But overall, we are on track for another week of a gain, up 0.6%, Matt.
All right, so watching a market climbing, I was going to say towards the close, but we still have, so a lot of time, 6 hours.
The weekend's not here yet, I regret
It'll
to
happen
say.
eventually. Coming up, U.S. earnings season kicks into high gear next week when Wall Street banks release earnings. We'll take a look at that next in depth. This is Bloomberg Open Interest.
A check on equity markets this morning. We're higher by 0.5% for the Russell 2000 index. That leads the way, up 1/3%. We're at the highs of the morning compared to where we were for futures markets. Maybe it's because Governor Waller said that the labor market is a concern to him, and we could be seeing negative payrolls growth. Next, it is your top calls of the morning, some of the analyst action that we're focusing on. First up, Morgan Stanley upgrading communications equipment company Ciena, saying that concerns around the margins are overdone. Even so, shares falling 0.6%. Comerica, that gets a downgrade from KBW and sets its price target to $93 after its deal with Fifth Third. The analysts say that the deal is positive for both banks, but downgrade brings Comerica's rating in line with Fifth Third. Those shares, though, are up 0.4%. Finally, Venture Global, that gets downgraded at Mizuho after an arbitration ruling involving BP. That decision finding that Venture Global failed to declare commercial operations at one of its facilities on time. A negative surprise, according to the analysts. Those shares getting crushed this morning, down 18.3%, Matt.
Absolutely crushed.
Crushed.
All right, let's talk about the far larger companies that are reporting, and most important really to us, the biggest banks in the U.S. Are going to come out with earnings next week. JPMorgan, Goldman Sachs, Wells Fargo, and Citi all kick off earnings on a banner Tuesday, followed by Bank of America and Morgan Stanley on Wednesday. For What to Watch, Bloomberg finance reporter Catherine Doherty joins us now. And Cato, this is going to be a big one, right? Because M&A is like back in a huge way.
We're seeing signs of a resurgence. That's right. It was the busiest quarter for initial public offerings that we've seen in years, since 2021. So what does that mean for the banks? It is likely that we're going to hear a lot of enthusiasm, not just for the quarter, but for the remainder of the year and potentially for the year ahead. A lot of the banks will come and talk about their both advisory and equity underwriting. Equity underwriting tied to this resurgence of the IPO market is likely to lift the bottom line for the biggest banks. As you said, we'll hear from JPMorgan and Goldman Sachs on Tuesday. We have Bank of America and Morgan Stanley the following day. Jefferies has already reported. They're the first to come out, and they've given some signs that, at least for them, they had their best third quarter on record. It remains to be seen whether or not the other U.S. banks are going to report some of their own record highs. But if the deal pipeline that is any indication, it's likely that this momentum is not just a sign for this quarter, but what's to come.
What about retail activities from these banks, Catherine? Everybody will be listening to Jamie Dimon, I'm sure, about what weather event he describes this economy as. But what are expectations for those areas of JPMorgan, Bank of America, Wells Fargo, the very retail exposed ones?
That's right. So listening to Jamie Dimon, Brian Moynihan on Tuesday and Wednesday, there's likely to be commentary about U.S. spending. There's always the consumer check-in where they will be comparing not just year over year, but quarter over quarter to see whether or not spending has slowed down. If there's any indication, also delinquencies within credit card rates. That's another sign that we'll be listening out for. But so far in the year, all that we've been hearing whenever analysts are asking these types of questions to executives on big conference calls, there really hasn't been any signs so far of any cracks or any sort of concerns that have emerged. That being said, if there's starting to be signs, that will be something that I am sure analysts will be emphasizing, not to mention the fact that with all of the BPI reports and that being delayed, there's now these signs coming from the U.S. banks that not just the bank analysts, but analysts at large will be looking and diving through the own reports from the banks to really get a checkpoint on how the U.S. consumer and businesses are doing.
Catherine, what about the bankers themselves? We've only got about 30 seconds here, but are they still desperately needed? Are they still getting paid? Is there still a talent war, or is AI coming in and doing more of the work?
I think what we've heard from so far is that the AI is helping with their work, but it's not replacing these bankers per se. Jamie Dimon is coming forward and saying that for his own cohort, they're able to work faster, and all of the money that they're putting into AI that they're actually seeing a return that almost equals or cuts out what they're putting in. So if we hear from more of the banks around that front, there's going to be a lot of pressure for them to really show and not just tell how AI is transforming their business and helping their bankers at large.
Gotta say, Catherine, it feels like that pressure is literally everywhere, whether it be banks or Levi's or some pharma company. Catherine, thank you so much. Looking forward to your reporting next week when you get those earnings, Catherine Doherty. Coming up on Open Interest, how an AMD ETF wipeout could spell trouble for other leveraged single stock funds. ETF Friday, that's coming up next.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on what's going on in stocks at this moment. The S&P 500 had appreciated up a third of 1%. Now it's up 0.2%. NASDAQ as well. So we're seeing some gains here. If you take a look at the biggest tech stocks, you can see a little bit of a split, right? Apple is a gainer. Actually, Apple and Nvidia are both gainers right now, but you've got Meta down just a little bit today, AMD down after a stellar run, Qualcomm down after that Chinese investigation, and Stellantis, even after a positive sales outlook, down 1%. It's a difficult job for Antonio Filosa over there to try and right the ship, Dani.
Yeah, that's painful. Even that 13% sales increase.
Yeah.
Point taken, Matt. Elsewhere, speaking of some pain in this market, Granite Shares was forced to shutter a 3-time short AMD exchange-traded product after shares of AMD surged and wiped out its entirety of value. The product aimed to offer 3 times the inverse return of the chipmaker, so you can imagine just how painful it would be. Joining us now is Athanasios Saravegas of Bloomberg Intelligence. Athanasios, it always blows my mind that these products exist, that a retail investor can invest in something that can literally blow up and go to zero. What does this saga tell us about what else is out there in the ETF market that risks a similar fate?
Yeah, well, I think first what it tells us is people feel so good about the market, right? That you have these blow-ups and it kind of doesn't really, measures don't skip a beat. But it definitely comes at an interesting time because you had mentioned these exist in Europe, but they don't exist here. But issuers are trying. Just last week, they filed for 3x versions of all these different stocks, and you had this blow up. So I think it's just a reminder that this risk of a blow up is actual real possibility for some of these stocks. And if you see what they're trying to put in these ETFs, it's not just AMD, right? And AMD is a pretty large cap company. They're putting small cap quantum stocks. They're putting meme stocks. So they're really sort of stuffing these really volatile names in these leveraged ETFs. So I wouldn't be surprised if we see more in Europe, or even, if these 3X are approved here, the possibility could also happen here.
I mean, if you put everything on Black 22, you got to expect that you could lose it all. Gambling, what we consider traditional gambling is more and more allowed. It feels like almost encouraged by regulators in the U.S. Can't we expect the same of the markets? Like, is there any question that we're going to be allowed to invest in riskier and riskier products?
Oh, I think there's no doubt. Look, NYSE just bought some shares in Polymarket, right? They bought a portion. So I think that there is this encouragement of wanting to gamble more. And if you just look at how ETF launches have changed over the year, like all of it is encouraging trading. Like a third of all the launches this year use leverage. A quarter of them are single stock ETFs. So it's really almost come full circle. It's all about, let's buy ETFs for diversified exposure. Now it's for single stock leverage. So I think it's just conducive with the market. The market keeps going up. These sort of bets on these speculative stocks are paying off. So the issuers are really just leaning into it and launching more and more of these products, upping the leverage. I think this gambling phenomenon is going to keep continuing.
All right. Athanasios, really appreciate your time. Athanasios Saravegas there of Bloomberg Intelligence. He makes up a triumvirate.
Oh, great word.
Of ETF reporters that we rely on along with James Seyffert and Eric Balchunas.
Yes, of course. Who, by the way, was pointing out, Eric Balchunas, the huge amount of flow into gold. Superlatives abound. It's so popular right now.
Yeah, and we're going to talk about gold later on in the
correct.
program. We have someone very important from the industry to tell us what he thinks about the $4,000 target. We also going to talk to Joanne Shu of the University of Michigan. Consumer sentiment data coming out, as well as James Lindsay of the Council on Foreign Relations. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. Markets trying to get back to record highs after losing momentum yesterday, helped this morning by Governor Waller saying that the payrolls report might be negative and more cuts need to come to this market.
That's right. And Governor Waller, potentially the Fed chair, as he is on the list of 5 that Scott Besson has narrowed down from 11. We're getting some data right now. University of Michigan consumer sentiment at 55. That's better than the anticipated or the survey number that we were anticipating, 54. It's also pretty much in line with the prior reading, 55.1. Current conditions, also 1 point better than the survey number and about a point better than the prior number as well. I will scroll down to the inflation expectations and see that's a better number than we were looking for as well. 4.6% is what we see in terms of one-year inflation expectations. We had been expecting 4.7%, and the 5 to 10-year is bang in line at 3.7%. For more on that data, we're joined by Joanne Shu, director of the surveys of consumers at the University of Michigan. And Joanne, let me start with inflation and just ask, because, you know, even though these numbers are better than the survey and better on the 1 year, at least than what we saw last time, are they still high? Is it still high for consumers to expect 4.6% inflation a year into the future?
Certainly 4.6 is not where we want to see inflation going into the future. To contextualize this month's numbers, we're about midway between where we were a year ago, closer to 3%, and the peak of inflation that we saw in April and May when people were really panicking about the tariff announcements. So we've come down quite a bit over the last few months, but consumers do not believe we're out of the woods. They're still expecting much higher inflation than they were just a year ago.
And to that point, it is the lowest consumer sentiment reading since May. Joanne, I got to wonder, how much of that is also about a government shutdown? Historically, that is weighed on sentiment.
So as it turns out, at this time, we're not seeing a whole lot of evidence that the government shutdown, the federal government shutdown, is really weighing on consumers one way or the other. But it's only been about a week. It took a couple of weeks in 2019 for us to see an impact on sentiment. So I think the final read of the month will give us a little bit more information about that.
So in terms of inflation, I hate to harp on this, but I look back at the graph and I don't see consumer expectations for inflation 1 year out at 2%, like ever. Does the consumer just not believe that the Fed really wants to get us there?
So I think we need to really bear in mind that the numbers that consumers have in mind aren't necessarily mapping one-to-one to the PCE inflation number or the CPI number. So it's really more important to kind of look at the trends that we see there. So there may be, I think, the inflation expectations that are consistent with a 2% target isn't necessarily going to be 2% on the dot. The key thing to take away now is that throughout 2025 and continuing on now, consumers are expecting considerably higher inflation than they were last year. And even last year, the consumers continued to be frustrated by the persistence of high prices. But, you know, of course, they did recognize that inflation had slowed from 2022.
I just wonder if you drill down into housing, because Neil Dudd of Renaissance Macro put out a note a few days ago that's really stuck with me, pointing out that even as mortgage rates come down, we don't see consumers taking advantage of that, applying for more and buying more houses. And he says it's because home prices are likely declining too, and that the consumer, that the home buyer can feel this, and that's why they're not going out and putting down money on a new house. Do you see that expectation in consumers at all, that home prices are going to start to move lower?
when we ask consumers about home buying conditions and home selling conditions, their views on this are loud and clear. They believe that prices are too high right now. And despite the recent relief in mortgage rates, they still believe that interest rates are too high. We have to consider that many consumers are holding on to mortgages with much lower interest rates and probably paid for homes that are not nearly the price that they're going for right now. So consumers still believe it's a terrible time to buy a house. And on top of that, we're seeing a lot of evidence in our survey that consumers are worried about weakening labor markets. So if you're not feeling confident about your own incomes, it might not be a good time to make a long-term investment of that size.
Joanne, I wonder if how you talk about the Michigan Sentiment Consumer Data Survey has changed over the past 2 weeks, just given that we're not given official data from the likes of the CPI report. Maybe we'll get it next week. That might be unlikely. We didn't get the jobs report the other week. Does your type of data that doesn't depend on a government being open, does it take on a new importance in this environment?
I think that any policymaker, any economy watcher is going to want to consult a full suite of data, and I'm really happy to be able to present this to the public every 2 weeks, every 3 weeks, depending on the month. Consumers themselves, as I said, don't seem to be that influenced by the government shutdown. When there were the developments around leadership of the BLS. That wasn't something that consumers were really thinking about a whole lot. Consumers are taking in themselves a whole lot of information around them. And so the consumer views, I think, are really important and do indeed become even more important indicator when we're missing data elsewhere.
Well, then you get oddities, Joanne, like Levi's earnings today, where they talked about the fact that the tariff hit is to come. At the same time, they've been able to raise prices and have a consumer buy pairs of jeans. Are we seeing this split as we've seen prior in months prior, where the sentiment starts to turn? There's concern about what's to come, but at the same time, consumers hold their nose and continue to pay up for things.
So I do think we're in a very different environment now than we were after the pandemic in 2022, when we also had very, very low sentiment and consumers were willing to spend through it. The reason they were willing to spend through it in a consistent and sustained basis then was because labor markets were incredibly strong, incomes were super stable, and consumers were very confident about those income prospects. And that's just not the case now. At the same time, stock markets are soaring. So there is a segment of the population that's really being buoyed by these strong asset values. But I think what's really important to note now is that there's a large variation in views across the income distribution across the population. So even though there are many consumers who are telling us that they are struggling, that they're worried about job loss, that they're worried that unemployment is going to increase in the year ahead, there is another segment of the population that still feels pretty stable and is still willing and able to spend.
We had seen, Joanne, previously huge splits along political lines. If you were a Republican, you expected almost no inflation under President Trump, whereas Democrats expected inflation to soar. Do you still see that breakdown in terms of confidence or inflation expectations?
There have been partisan differences in both of those things dating back at least to the Reagan administration, so that's not new. However, in April and May of this year, with the escalation of trade policy developments, we saw an enormous kind of pulling apart across the political spectrum, where Republicans were expecting a best case scenario and Democrats were expecting a worst case scenario, with independents pretty much in the middle but showing some skepticism. Since the worst fears of skyrocketing inflation haven't come to pass, and at the same time inflation also hasn't gone to zero on the other end of the spectrum, both ends of the political spectrum have moderated their views since then, though we see, again, the same partisan splits that we've seen since the 80s.
Joanne, really wonderful to have you on. Thank you so much for joining us. Joanne Shu of the University of Michigan, after consumer sentiment survey data, more or less in line, slightly stronger, but still hovering around the lowest level since May. That having little impact on the rally that's been underway. After yesterday's loss of momentum, we dipped yesterday. We're buying today, up 0.25% for the S&P, up about 0.2 for the NASDAQ 100. It is small caps that are outperforming thanks to bond yields that have dipped back below for the 10-year yield below 4.1%. And Matt, I still go back to this bespoke statistic that micro caps, which you'd assume are insanely risky, have outperformed the S&P 500 by 20 percentage points over the past 6 months. It just shows how there are corners everywhere that are participating in this rally, be it micro caps or crypto, for example.
Or meme stocks.
Or meme
right?
stocks,
and,
yeah.
Our producer Dan Curtis was talking about this morning, and you see this return of meme stock froth. So it makes sense. You want to get your tendies, right?
You gotta get them tendies.
Let's get a look at some of the single stocks moving at this hour. They're not micro caps, but China is investigating Qualcomm for suspected violation of the anti-monopoly law over its deal to buy Outtalks out of Israel. It's the latest in a string of tit-for-tat moves as Presidents Trump and Xi jockey for leverage before a key meeting in Asia at the end of this month, and it brings Qualcomm down to a market cap of just $176 billion.
Wait, so does that bring it under Intel? Have we surpassed
I think
that?
Joe has the chart, so we can take a look. I'm not sure that we see enough in terms of the drop in Qualcomm. Intel has some pretty significant gains.
Well, there you go.
Yeah, it does look like Intel has now surpassed. Intel is worth $181 billion, according to this chart, and Qualcomm down to 177.
There you go, a changing of the guards, just barely passing through. Elsewhere, Matt, also on tech, but in the hot area, not in the concerned area. Applied Digital, it's a data center company, says it's now in advanced discussions with a hyperscaler client for its second data center campus in North Dakota. It also reported fourth quarter revenue that was well ahead of estimates. And we were talking about this with Abby Yoder earlier, just this idea that you can't really be a generalist. You have to understand this market and AI so well to participate in the rally, because who had heard of Applied Digital? I'm sure some people had, but in order to have gotten ahead of this, you needed to know the AI story incredibly well. You can't just be a casual observer.
Have you seen Field of Dreams, the Kevin Costner baseball flick?
I haven't. Are you going to be mad at me
If
about
you
that?
build it, they will come. That
okay,
was the
yes,
whole
of course.
premise.
Yes.
And something similar going on with these data center campuses, right? We're going to make 50 gigawatts of power, but we don't have clients yet. Levi's raised its full-year outlook, but shares are down bigly after warning that tariffs are starting to have an impact. What did you expect? Nonetheless, the company has done well so far. The stock has done well so far this year. It was up 45%. Now it's been, decimated. But nonetheless, it's still a gainer. If you look at it year to date, Levi's still up 27.2%.
So not too bad considering that. Also not too bad considering they had expanding profits, but I guess the concern is that it maybe won't last. Okay, coming up on the show, Israel and Hamas reach a breakthrough ceasefire deal after 2 years of war. We're going to unpack what it means for the region with James Lindsay, senior fellow at CFR. That's coming up next. You're watching Bloomberg TV.
Let's get out of high interest. Look at what's making headlines around the world. Japan's 26-year ruling coalition fell apart today after talks between the Liberal Democratic Party leader Sanae Takaichi, I think I did pretty well, and junior partner leader broke down over political funding reforms. She refused. The split leaves Takaichi scrambling to form a minority government just weeks before major regional summits and a visit from President Trump. Investors, meanwhile, are bracing for political gridlock and a possible snap election. Not a lot happening to the yen because it takes two to tango, and investors aren't really selling the dollar off too much. Venezuelan opposition leader Maria Corina Machado won the 2025 Nobel Peace Prize for her fight to restore democracy in a country sliding deeper into authoritarian rule. Her award comes as President Trump, who campaigned hard for the prize himself, ramps up pressure on President Nicolas Maduro's regime. The committee called Machado a steadfast voice for a peaceful transition to democracy. So maybe President Trump is happy for her. The president says he'll travel to Israel to be on hand for the release of hostages under the terms of a deal that would end the war with Hamas. Even as Israelis and Palestinians celebrated the deal, there were concerns about whether or not it will stick. Remember that President Trump and Netanyahu gave Hamas 72 hours to release the hostages on September 29th, and we're still waiting. Let's get insight now into what's next in the Middle East. We're joined by James Lindsay. He is a Marion David Boys Distinguished Senior Fellow in U.S. Foreign Policy and Director of Fellowship Affairs at CFR. He joins us now from Washington. I guess my main question, James, is will this happen? Are you confident that the hostages will be released? Hamas will give up any control that it still has over Gaza and that Israel will pull out?
Well, Matt, there's great reason to be optimistic about completing the first phase of President Trump's 20-point peace plan. We've had the ceasefire go into effect this morning. Israeli forces have begun to withdraw. That's opened up the 72-hour window for the hostage release, for sending humanitarian aid into Gaza. But I think, as your question implies, there's a lot more diplomatic work to be done after this first phase. And as I say, there's the devil in the details, and there are a lot of details here that have to be worked out.
To that point, Hamas has yet to agree to lay down its weapons or cede control officially of Gaza's future governance, which was part of this plan from President Trump. What is the likelihood that Hamas would actually agree to that?
Well, I think it's going to be very hard as a goal to achieve, but it's very clear that the president is going to be leaning on Hamas through its intermediaries, relying on Arab governments to put pressure on Hamas to act. I think likewise, the president's going to be leaning on Prime Minister Netanyahu to try to create a situation and settle in the issue of the future governance of Gaza. And again, these are big, tough issues in which both sides have deep interests in sort of getting things to turn out their way. So again, big, important first step, but many more steps to go.
What does this say about the power of the president, the power of America? I thought we were past the point where, the U.S. is the world police and, Pax Americana is the most important paradigm to pay attention to.
Well, Matt, President Trump's not a big fan of Pax Americana, but he is a big fan of American power. And he saw it in his interest, in America's interest, to try to get a deal done here. Because it's not just the interest of Israel and Hamas that are affected, but interest in the Middle East, U.S. relations with Arab capitals. And the president clearly saw there was an opportunity here to bring this war to an end. We hope he succeeds in that goal. And he has been willing to put pressure not just on Hamas through its intermediaries, but also on the Israelis. And he's going to go to Israel next week. He's apparently going to address the Knesset. And we'll see what message he has for them in terms of how the future is likely to unfold.
James, we'd be remiss if we didn't ask you also about the Nobel Peace Prize, because there had been reports that the Trump administration was lobbying for the president to get it because of his efforts in brokering this peace deal. He did not get it. Is there any risk of fallout in a relationship between Norway and America off of the back of it?
I think not, or at least nothing that is going to be long-lasting. I think it's worth pointing out that under the rules that the Nobel Peace Prize Committee follows, nominations are supposed to be submitted by January 31. The committee was very clear that in awarding the prize, it was focused on events that happened in 2024. The award went to Ms. Machado because she was the opposition leader who would have been the likely presidential candidate back in 2024. She was not allowed to run by the Maduro government, but she nonetheless helped orchestrate a very successful campaign that would have, if it had been a free and fair vote, seen Mr. Maduro sent packing. That didn't happen. I do think the Nobel Peace Prize Committee is trying to send a message about its concern about the retreat of democracy around the world. It used that phrase in its citation. And I would say for President Trump, looking forward, if he in fact can make this peace deal in Gaza stick, and again, it's still a big if, it's a lot more work to be done, I would imagine he would have a pretty good case for the Nobel Peace Prize in 2026.
Alfred Nobel laid out in his will 3 criteria for the Nobel Peace Prize, that the winner support the fraternity of nations, the abolition or reduction of standing armies, which is hard to argue that we're doing here in the U.S., and the promotion of a peace Congress. That is to say, not unilaterally dealing with other countries, but with an organization of multiple countries, like the United Nations, for example. Do you think the president can fulfill all 3 of those?
Well, I'm not so sure that the Nobel Peace Prize Committee applies those three criteria in a mechanical way. It has given the Peace Prize to a large number of people doing diverse things over the years. Some have been individuals, some have been organizations. There have been 4 American presidents who've been awarded a Nobel Peace Prize. Seems to be particularly when the committee gives an award to an individual, a political leader, it is typically because they have done something to bring about the settlement of a conflict somewhere around the world. Teddy Roosevelt was the first American president to be awarded a Nobel Peace Prize, and he received that because of his instrumental role in negotiating a peace between Japan and Russia over their war. So I don't know that I would sort of stick to sort of a mechanistic sort of view of how the Peace Prize Committee makes its decisions.
James, really wonderful to get your thoughts this morning. Thank you for your time. James Lindsay, a CFR. Still ahead, the rally in precious metals, silver surging towards an all-time high. It has outpaced gold's advance this year. Just how much higher can it go? We'll break it down with Randy Smallwood, Wheaton Precious Metals CEO. That's coming up next. You're watching Bloomberg Open Interest.
All right, let's take a look at the S&P with the move screen right now. You can see that we had some decent gains up to about 1/3 of 1%. Right about a half hour into the trade, we come back down, and now we're headed higher. The breadth is pretty evenly split. 277 stocks gaining, 223 to the downside. More on the upside. That's why we have 16 points, a gain of right now about 1/4 of 1%. Nvidia, Apple, and Broadcom all on the upside. Really doesn't hurt when those three together are adding more than 10 points, almost 12 points here. On the downside, you've got Amazon, Microsoft, and AMD really weighing on the index. Take a look at the industry groups because I want to take a look at the last week, what we've seen so far. Actually, 5 out of the last 6 weeks have been gains. This week, we're looking at a gain as well, only about 0.5%, but it's interesting because only 4 industry groups of the 11 that we track on the S&P are gaining. The other 7 here are down. Coming up, we take a look at the record runs of gold and silver.
Precious metals are seeing a major run this year, driven by a number of forces, macroeconomic, otherwise. Gold and silver have outpaced the S&P 500 this year. And what's more, silver vastly outperforming gold. Gold's up about 50%, silver nearly 75%. For a read on the industry, we are joined by Randy Smallwood, Wheaton Precious Metals CEO. And Wheaton Precious Metals is a precious metal streaming company with a portfolio of gold, silver, palladium, platinum, and cobalt assets. So Randy, you've got a lot in your arsenal. Silver has really started to take off in a big way versus gold. What do you make of that outperformance?
Well, Dani, we've been operating in a deficit mode in the silver market for a long time. We hit peak silver production back in about 2017-18, and then production's been declining ever since. And basically what's been feeding that deficit is the vaults, vaulted silver. But those vaults are now running dry. We're not, there's not as much available, and yet I always call it it's the perfect critical mineral in terms of the industrial applications for silver just make the world a better place. They make us use either less energy or move energy more efficiently. So when it comes to mobile electronics, which we all have from rings to cars, the more silver we use, the better the world is. And so that increasing demand for silver combined with a declining production profile has finally caught up to the price.
When you say the vaults, are you talking literally about the London silver vaults under Chancery Lane? Are they actually running out of silver products?
They and a large number of vaults all over the world, right? So yes, you can't operate, in the resources industry, if there's that industrial demand and that investor demand that comes into play, you can't operate sustained periods of time. Like, as I said, since 2017-18, in deficit mode. Eventually, you're going to run out of the material. And one of the unique things about silver is that most silver is produced as a byproduct. It usually comes from lead zinc mines and from copper mines, more than half of silver. And so unless lead zinc prices and copper move, you're not going to see more silver production. The actual silver miners only contribute about 25 to 30% of total silver production.
Your job is so interesting, Randy, because of course you're not a miner. You basically are providing upfront payments to miners in exchange for the rights to buy metals at a discount sometime in the future. But given the fact that prices are at records right now, how are you thinking about those investments?
Well, I tell you, it sure helps on the cash flow front. We're doing very well on that front. The growth that we have, I don't think we could have timed this any better because we have 40 to 50% growth over the next 4 or 5 years at Wheaton. Just a number of investments that we've made over the last 5, 6 years are all coming into production over the next 3 or 4 years. And so that good, strong growth, I don't think we could have timed it any better to see this move. We've always known that silver moves with gold, but it always lags and then outperforms. And I think that's what we're starting to see now is the outperformance. I think we've set ourselves up perfectly for it. About 35% of our revenue comes from silver. The rest of it, most of it is gold, about 64% from gold and 1% from other, as we call it. As a company that's entirely focused on precious metals, and especially in contrast to a bunch of our peers, we have focused purely on precious metals. I can't think of a better environment for us and our shareholders right now. It's created great opportunity where of course the cash flows are growing, and it gives us opportunities to continue looking for ways to invest back in and continue growing our company.
We have just over a week, Randy, until Diwali, the Indian festival of lights kind of thing, and I hear that is a huge demand for gold around that holiday. On the other hand, we also hear reports of central banks buying a lot more gold around the world. Can you shed some light on how much gold is being purchased by each of those factions?
Central banks are the real driving force behind what started gold's move in the last 2-3 years here and pushing it up hard. There's just a big concern worldwide about U.S. dollar treasuries being held in central banks and the long-term value there. And so what we've seen is a real shift towards gold. And, as of I think it was last week, actually, we finally saw gold surpass U.S. treasuries as a core holding, in terms of percentage of value within central bank reserves. But we're nowhere near the peaks that we saw back in the 70s and the 80s. In the 70s and the 80s, we had substantially more, twice as much gold in central bank reserves. So there's all sorts of opportunity. We know that, for instance, China would really love to have the renminbi be, much more respected as a reserve currency around the world or as a utility currency around the world. And yet they've only got about 2,000 tons of gold backing their central bank, whereas the United States has over 8,000 tons. That's 6,000 tons of demand right there. And so I don't think the central bank shift is going to slow down at all. I think it's actually accelerating and moving forward, and I'm even more bullish about the impact that's going to have on gold. I don't have a problem seeing gold up over $5,000 in the very short term on a per ounce basis. And what I'm most excited about is I'm starting to hear central banks talk about bringing silver back into their reserves too. There's noise from several different banks around the world that maybe silver should be a part of their central bank reserve base, and that of course would be very exciting for silver. It's been a long time, been 20 plus years since we've seen silver held by central banks.
So that's a lot more maybe than Indians buy at Diwali, but it doesn't really dwarf the amount of gold that the Indians buy annually. I see, according to the World Gold Council, that they import 800 tons of gold annually. And of course, you're very familiar with the World Gold Council, having chaired that organization. How key is India, relative to other nations in terms of their consumption, retail consumption of gold?
Oh, it is. It is probably one of the biggest retail centers in terms of gold consumption over the course. And keep in mind, when they invest into gold jewelry, it is an investment as a store of value. They know that gold will carry value for for forever, and it has for thousands of years. And so it is a very cultural significance. And I hear forecasts that because of the higher prices, it might not be as much consumption this year on that side. That's more than offset by what I think just broader investment demand and central bank demand. So it would surprise me to see record years in terms of Diwali investments into gold just because of the higher prices on a per ounce basis. But still strong strength. It's a core part of the culture. It's always been celebrated as a real sort of presentation of value and a store of value in that culture.
It is remarkable, Randy, just to hear you talk about this, because when gold was approaching 2,000, 3,000. We were talking about that moment, about real demand destruction coming in, and it hasn't happened. We're just under $4,000 right now. We'd be remiss if we didn't ask you, where could gold go? And silver, how much higher do you expect prices to move?
Oh, I'm confident we'll see gold over $5,000 within the next year, over $5,000 an ounce. The question that we all have to ask ourselves is that we're measuring this in U.S. dollars, and I think that's really the issue here. Is that it's the measuring stick that we're using. It's the U.S. dollar that we're all seeing. We're all concerned about in terms of long-term strength. The debt levels, the interest payments, real rates are going to have to. The only way for the U.S. dollar to maintain any sense of value and to balance is to get to negative, near negative or negative rates, and all of that bodes poorly for the U.S. dollar on a comparative value basis. And so that's what I think drives my optimism for the price of gold. Is as long as we're measuring it in U.S. dollars, I don't have a problem seeing gold over $5,000 an ounce, and in fact, it's a trajectory that could easily put it up to $10,000 an ounce within, before the end of the decade. It wouldn't surprise me at all.
The first time I heard the word triumvirate this morning, it was in relation to dollar alternatives, right? Gold, tech stocks, and Bitcoin. Randy, does Bitcoin does that take up any part of your day in terms of your thinking, in terms of your operations? As a digital gold, do you put any stock into that at all?
First off, I think there's enough demand to satisfy both markets. The challenge that I have with Bitcoin, and I've always had with Bitcoin, is that it can be copied. Bitcoin itself is the current trend. It's the top of the cryptos, the most popular of. But what's the next generation going to think 5-10 years from now? Is it going to be Bitcoin number 2 or whatever it's called? And that's the challenge that I have, is that there's nothing of substance behind Bitcoin that makes it unique, other than the fact that it's the most popular one of today's world. Gold can't be copied, and that's the big substantive difference between gold and Bitcoin. I have to repeat a quote that I heard earlier last week that I thought was quite unique, where it was someone from the crypto space who kind of looked at gold and said, it's a natural stable coin. Like, I didn't know that really existed, right? I mean, we're going the other way now. We're having some definite interest back. But that's the one thing, the one aspect that concerns me about Bitcoin is that it doesn't have a uniqueness to it. It's other than its name, which can easily be replaced by the next trendiest cryptocurrency when it comes down the pipe 5-10 years from now. Gold can't change. It can't be copied.
Randy, I'm still thinking about 10,000 on gold by the end of the decade, because the past 5 years we saw a rally of 100%. That would imply a rally of 150% over the next 5 years, over the same period. What does the world look like if gold is trading at 10,000? That's obviously more than the inflation rate than we would see over that. How much does it just shift the structure of this industry?
Well, it's not so much the industry, and I agree. I mean, when you look at the gold mining industry, the margins are incredible right now. I've never seen a worldwide gold cost curve that has such a big gap between the spot price and the costs. And so we in this industry that deliver gold to the market, are definitely going to be doing very well over that time. But what you have to keep in mind is that we're only adding about 2 to 3% gold to the entire market. And the unique thing about gold is that just about every ounce of gold that has been mined historically over time, over the last couple of thousands of years, is still being used. It doesn't get lost. It's not consumed. It's still being used as either a store of value, a measure of value, jewelry, et cetera, et cetera. We don't throw it away. And so the mining industry, of course, is doing very well, but we're not going to have a big impact in terms of oversupplying because all gold that's ever been mined is still being used, and we don't have at 2 to 3% new production per year. Not going to have a big impact on the overall pricing and demand. And so, what does the world look like? I think we're going to get back to, I hate to say it, the middle of the last century when most reserve currencies were backed by gold. And so what the world looks like is I think the world is looking for something that is a reserve currency or a reserve measure that has gold backing. The US dollar had it until 1970. I would say it's a 55-year experiment that's clearly going wrong right now, and it's time for gold to catch up again as, whatever backs that worldwide respected reserve currency.
Randy, you say that miners are doing well, and I'm sure that they're happy about the price rising, especially at this pace, but electricity prices are also going up. Are we going to see some doing better than others? Are we going to see some consolidation? Do you expect maybe even accelerated consolidation because of this move higher?
There's no doubt. I mean, it's one of the advantages that we have as a streaming company is that we're not subject to that. But inflationary pressure is going to push costs up, and we've seen that traditionally in every type of mining industry. It doesn't matter whether gold, copper, or whatever. When prices go up, typically so do the costs. The costs wind up chasing, and sometimes even faster.
And is power the biggest input cost?
Yeah, power and labor costs. Especially power, because most mine sites are remote, and so you wind up having to either generate with diesel generators, which is incredibly expensive, or come up with other alternatives, and that's one of the challenges. And so it's really power and labor costs that drive inflationary pressures on mining sites. And so the one advantage of the streaming model, our business, is that our costs are fixed, our costs are defined, and so we don't have anywhere near that same exposure. That's the promise that we deliver to our shareholders is you get all the same benefits of a good mining operation without the risks of cost inflation, both on operating costs and on capital costs up front. Our costs are all defined and fixed in the contract, and so it's a huge advantage really what I would position a company like Wheaton is the foundation investment in everyone's gold portfolio. And then you can step into the miners and look for that. And the unique thing about the mining industry is every deposit is different, every mine is different, every company is different because of that. And so it is important to pick the good ones, the ones that have good, healthy margins, the ones that have experienced operators behind them. We have always been very selective about our investments in terms of making sure that you choose the right people, but you also choose the right ore bodies, the right deposits to continue delivering. And it's one of the reasons why we got such a strong growth profile.
Well, it's something we could talk about for a long time, so we hope you come back soon, Randy. Randy Smallwood there is the CEO of Wheaton Precious Metals. Let's get a check right now what's going on in the stock markets, which feel relatively boring, having just talked about gold for 10 minutes. We're looking at gains. S&P 500 up 0.2% at 67.47, so not back to a record high yet, but headed that direction, and we may get there at the close if we continue to see this drop in yields, right? We're down at 410 right now after those comments from Chris Waller that he's going to continue to cut because he thinks we've had 2 months of negative job creation, which is the same as to say 2 months of job destruction.
Correct. And of course, we won't know that for some time considering the government is closed and we're waiting for official data. Okay, Matt, coming up on the show, how private prison companies are profiting from the Trump administration's immigration crackdown. We're going to bring you the Wall Street Week conversation coming up next. This is Bloomberg Open Interest.
Time now for Wall Street Week. This week's episode looks at private detention. David Weston spoke with the CEO of a company that owns and manages private prisons and detention centers on the impact of tougher immigration crackdowns.
Damon Heininger, a former correctional officer, now leads CoreCivic, one of the largest private prison and detention operators in America.
Our very first contract was with then INS, now Immigration Customs Enforcement. But the value proposition is to bring private sector innovation, being very nimble, being very flexible, provide high quality solutions and outcomes at a very low cost to government.
Along with the ramp up in immigration enforcement has come more demand for CoreCivic's services. Not even a year into its second term, the Trump administration says it has deported more than 400,000 people, which comes at a big cost for the government. Earlier this year, Congress passed the One Big Beautiful Bill, authorizing roughly $170 billion for immigration and border operations. with $45 billion designated just for detention capacity expansion.
We need detention facilities. We need beds to put them in place so that they can have their due process before they return home.
Some 60,000 people are currently detained, with nearly 90% of them in private facilities owned or operated by companies like CoreCivic or Geo Group, its main competitor, and that's helping drive profits. According to CoreCivic's second quarter earnings figures, ICE contracts account for a majority of its revenue.
We don't get involved in policy, but obviously there has been a lot of discussion, leading up to the campaign and the election last year and this year about, getting stronger enforcement on the southwest border and also doing a fair amount of interior enforcement with DHS and in turn our customer ICE. We obviously didn't know what the outcome was going to be in the election, but I've always stressed this as CEO to plan well in advance before there is, an outcome on our national election, especially like the one we had last year.
Investors moved quickly after the 2024 election. CoreCivic's stock jumped before President Trump was even sworn in, as Wall Street priced in tighter immigration enforcement and more detention spending. The explosion in ICE detentions may have been good for the business of companies like CoreCivic, but it's come with a fair amount of scrutiny and criticism. Margot Schlanger, a University of Michigan law professor, previously served in the Department of Homeland Security in the Obama administration, overseeing civil rights and liberties of detainees.
There is a range of conditions. Some of the detention facilities are better than others, and some of them are more stressed than others and are less good at dealing with the stress of high populations or particularly needy populations.
Why is it that the federal government essentially delegates this or contracts it out to private companies?
Congress made a decision a while back that it didn't want to set up the Department of Homeland Security to run a large system of detention and run it itself.
You can catch Wall Street Week tonight and every Friday at 6 p.m. New York time. This is Bloomberg.
The biggest banks in the U.S. are set to report results next week. For more, we are joined by Sri Natarajan, Bloomberg's chief Wall Street correspondent. And the big buzzy number is the $1 trillion of global deals that have come to the market in the third quarter. The second time that's ever happened, of course, EA helped with that. How much is that going to follow through to the bank results that we're going to be seeing?
I think not necessarily in the fees that will be reported in the third quarter, but you don't need to rely on the $1 trillion in the third quarter to tell you that there has been a deal-making rebound. That has been the trend for the last 12 months or so. And so when these banks report their numbers, the biggest banks, you will see a big tick in the investment banking numbers. And the deal volumes clearly point to that, expand beyond just the third quarter and year to date. And you've seen a big uptick in year-over-year growth in deal-making volume. When you look at North America, it's about a 40% increase. David Solomon was on Bloomberg TV last week, and he talked about the mega cap segment, the $10 billion plus deals, a segment where Goldman Sachs tends to do really well. That's been up 100% year over year. So that obviously means that advisory fees at the biggest banks will be up quite a bit. And as one of the analysts pointed out earlier today in one of our stories, that this will also have a multiplier effect. You're not just looking at that advisory fee line. There will be trading related to it. There will be debt trading. You will have financing and hedging activity tied to divestitures. So it will have a good spillover impact that will make these results look good. So heading into year end, it's looking good for these banks, especially those with big investment banking operations.
Sri, we're running up against a hard break. Otherwise, I'd ask you a million more questions. Thank you so much for joining us. Sridhar Natarajan runs our bank coverage here at Bloomberg. Coming up on Monday, we're going to talk earnings season with Nancy Tangler of Laffer Tangler, Katrina Dudley of Franklin Templeton, and Stephen Bigger of Argus Research. We've got a lot going on, so definitely tune back in. But right now, chill out. Put your feet up. It's Friday.
It's Friday, and we're rallying. Not yet back at record highs, not too far from it. And you know, negative payrolls is a good thing for this equity market right now, with small caps rallying 0.4%. All right, that is it from Matt and me. Bloomberg Open Interest. Enjoy your Friday and the rest of your weekend.